Okay, now what we are going to do is we are going to post from the journal to the ledger the information about Bob Capital. If you notice, we have Bob Capital. That's the account we're dealing with in the ledger. The number is 301. And we are not going to need an explanation again, right? Because the explanation is included within the journal entry. So our reference, again, should be J1. Our reference is J1, right? And in this case, Bob Capital, we have a credit, right? So we have a credit of $20,000. Our balance is $20,000. And then we're going to go ahead and reference that ledger that ledger account number in that page of the general journal. So we're going to go on now to our next item. Okay, as you've noticed, I have listed assets equal liabilities plus owner's equity. I'm going to step over here. If you notice, I already did our first transaction because we just did that when we were looking at how to post from the journal to the ledger. So we have cash debited for $20,000 and Bob Capital for $20,000. And that was our first transaction on the practice problem. So as you notice, I couldn't do this one after the other because I would have ran out of room. So the order of the assets is cash, then accounts receivable, then supplies, then prepaid insurance, and then equipment. So let's take our second transaction. Bob pays $1,200 for a 1-year insurance policy that will expire on December 31st. Okay, so he's paying insurance ahead of time. That's an asset. Prepaying something, prepaying your expense, is considered an asset until the time the expense is actually incurred. So at this point in time, we have prepaid insurance, which is an asset. We are increasing an asset account, right? So we are going to go ahead and we're going to debit prepaid insurance $1,200. Now, how did we get that insurance? We paid for it, right? We paid cash for it. What are we going to do? Cash is an asset account, right? So to decrease it, we need to credit it. Remember, credit's on the right side. So we're going to, and I'm just numbering these to keep track of the transactions rather than the dates because we don't have a lot of room. So we're going to go ahead and credit cash $1,200. Our next item is we purchased office equipment, and the dollar amount that we bought that office equipment for was $5,000. And we bought it on account from B Company. So we didn't pay for this, we bought it on account. So first of all, we're going to go ahead and debit office equipment for $5,000. And now we're increasing an account, right? We're increasing accounts payable, bought it on account. Since accounts payable is a liability account, in order to increase that, it's not an asset account, it's not an owner's draw account, it's not an expense account. So in order to increase that, we've got to credit it, right? So we're going to credit accounts payable. The next thing we're doing is we performed a service. So we billed $20,000 for services that we performed to C Company. So in this case, we're going to go ahead and debit an accounts receivable, right? Because we didn't receive money for it. They still owe it to us. It's an IOU. So we're going to go ahead and debit accounts receivable. What account do you think we're going to credit? Remember, for every debit, we've got to have a credit. So what account would that be? It's a revenue, right? So we're going to go ahead and credit revenue, $20,000. Okay, the next thing Bob does is he borrowed cash. He signed a 2-month, 5%, $1,000 note payable to get some cash. So we are going to go ahead, we got cash, right? So we're going to go ahead and debit cash for the $1,000. And we're going to credit notes payable for the 1,000, right? So we're increasing our notes payable. It's not an asset expense or owner's draw account, so we must credit it to increase it. The next thing Bob does is he